What is up, everybody? Welcome back to Bitcoin and Markets. My name is Ansel Lindner. Happy CPI Day. It is Wednesday, September 11th, 2024. And I was already sharing my screen. Let me stop sharing that. So welcome back to the show, guys. We're going to go over CPI. We're going to go over market reaction, what this means for FOMC, all of that. Take a look at the Bitcoin price because Bitcoin really did hold up well today. So, all right, now let's go back and share the screen. We are going to go first to the BLS website. We did go over this in a quick live stream on Telegram this morning, right during the drop. I did share that video then as well with Twitter, but I didn't have time to set up all the live stream stuff because I only had a few minutes at that time. So we're circling back. We're going to do this, cover what we had here for August CPI. As you guys probably know, CPI increased month over month at 0.2%. That was what the Cleveland Fed had it at. I think theirs was actually 0.18. So this will be the first time in like 4 or 5 months that they have been slightly above. Actually, I should go back. Let me just go and check that. If you guys are watching, I am live streaming on YouTube, Rumble, Twitter, and Telegram. If you guys are watching on Twitter, jump over there to the YouTube or Rumble. Like, comment, subscribe over there. It's easier to do that. Okay, so we have here at the Cleveland Fed. Let's go look at their historical. This is the quarterly, monthly down here. And then we switch up to August. And you can see they had CPI at 0.20%, and it actually came in rounded from 0.18%. We're going to go over another chart of that. So they did miss it once again, but this time was a much smaller miss, only 1/100th of a point instead of 1/10 of a point month over month. However, core CPI, they missed to the downside. It came in a little bit hotter, as you can see right here. And what's this one? Core PCE, well, that's still okay. So that's what the Cleveland Fed had as their forecast. And it actually was pretty accurate this month, but usually it's not all that accurate. So anyway, we have over the last 12 months, it came in at 2.5%, which this morning I said that looks a little bit off because it was 2.9% last month. This was only a 0.3% base effect. So you would expect that to come in at 2.6 and not 2.5%. But we will take a look at this. There is some funny business going on here. I don't know if it has to do with the seasonal adjustment or not. The index for shelter rose 0.5%, and that's a huge part of the index. I think it's something like 35 to 40% of the entire index comes from shelter. And if it's rising at 0.5%, that's going to take up a bulk of the increase. It's actually over 100% this month, and we'll take a look at that chart here in just a second. What else is important here? Where's the energy component? Energy component came way down. Let's take a look at the chart here. So energy was down 0.8% month over month. That's 4% over the last year. You see gasoline is minus 10% over the last year. Is negative 0.6% this month. And the shelter here, down here, 5% for the year. But again, this is more than a third of the overall index. So that is really heavily weighing on the index. So let's take a look at what I said there. This is the month over month CPI. And you can see it came in here at actually 0.18. Now, this morning I did go through kind of the very important point that is right near this level, okay? So the Fed's target is 0.16 because they target 2%. And if you annualize 0.16666, repeating, that comes out to 2%. And so these last few months, this one, July, June, May, they were all under that target, right? So it looked like the Fed was coming in under target. And this one at 0.18 that is slightly above the 2% target when you annualize for the month here. So that's why it's kind of an important level, but we should expect CPI to remain at this level or below over the rest of the year because the economy is slowing down. Prices are coming down as people are pulling back their belts, and retailers are having a hard time clearing their shelves. So anyway, let's take a look at the other one here that is shelter specific. So what we did was, this is all items less shelter in the CPI. So you can see if you take out shelter, we're at negative 0.1 month over month. That means the shelter component is more than 100% of the total CPI. It accounts for 0.3%, and the total CPI was only 0.2%. So, man, this is looking quite recessionary, even accelerating to the downside here. So you can see here in June, 0.08, then back up to basically zero, and now 0.11. So a little bit of an acceleration to the downside on CPI less shelter. So it's not all about prices at the grocery store and all of that stuff. I mean, if you hear people talking about that, they're just thinking in their mind about 2021 and 2022, when we had the high rate of increases in food and all that stuff. Of course, it takes time for people to adjust to that. It takes time for them to change their shopping behavior. It also takes time for their wages to adjust, and some wages aren't adjusting, and that's why we're going into recession, because people they can't afford things. They're having to pull back their purchasing, which then affects employers who are selling to those customers, and they have to lay off people, and on and on and on. So it does feel, of course, like prices are still rising. They're rising, but very, very slightly. And overall, if you take out shelter, the overall CPI is negative for the last 3 months. And the four months back in May was barely above zero, basically at zero. So that's a pretty significant statistic there. All right. So what happened with the odds of a rate cut? This is the CME Fed Watch tool, and let me refresh. If you guys are watching over there on Twitter, jump over to Rumble or YouTube. Appreciate that. If you go over there and like, comment, and subscribe, that of course helps out the show. So you can see we had a big shift here to a 25 basis point cut, up to 85% likelihood. That's what's being priced in right now in the market, down to 15% of a 50 basis point cut. But you can see just in the last week, this has really flip-flopped back and forth. All right. They actually have a history here. Where's the historical? You can see right here on August 5th, stand by. Those little dogs have the most annoying shrill barks. Anyways, okay, so you can see back here on August 5th, the likelihood of so this green one is 125 basis point cut, fell all the way down to below 20%. It was actually at 15%, and the other 2 basis point cut, you can kind of see here in this key, when I go over here, the 50 basis point cut was 85%. So that was, I mean, it wasn't a week ago, it was a month ago. And you can see how fast that has flipped. So yeah, there's a lot of kind of volatility right here in this prediction, in the pricing in of what's going on. And we still do have a week. So a lot of things can change. I think that a 50 basis point cut is more likely, actually, just based historically. And I understand that the market is pricing this in. So it's bold, probably wrong to second guess the price, what the market is pricing in. But I think the chances are much higher than this is saying that we're going to have a 50 basis point cut. Really, nothing has changed. The CPI, yeah, it was slightly above. You know, is one of these that in a downtrend, you might have 1 or 2 months that go slower or faster than the rest of the time. And this just happens to be one of those months. It will probably resume throughout the rest of the year with CPI continuing to cool. So there's that. All right, what else did I have on that? Nothing. Let's go to the charts. So Bitcoin is looking pretty good. Let me make this a little bit bigger here for you guys. So Bitcoin is looking pretty good on the day, just down $99 right now. Did have a pretty significant sell-off all the way down here to 55 this morning after 55,500 after the CPI, but now has recovered all the way back up. It was pressure. It did cross 58. The high was 58 exactly on Bitstamp today. So that's very interesting. 58K gang, they are dominating the price right now. But yeah, this is telling me that the price is very strong and probably moving up. Let's take a look at some other macro stuff here. So we have, well, before we get to the macro stuff, let's look at Ethereum. Just, I mean, if this doesn't make you very bearish as an ETH head, then I don't know what does. It just looks like there's zero demand here. It's just constant selling. And let's just zoom out here for fun. Oh, where, what? No, oh, your heart should be bleeding right now. Oh man, it's broken. My heart's broken. Look at that. I mean, just going back almost 2 years, it's nothing but downward price movement relative to Bitcoin. Okay, this is relative to Bitcoin. I don't know why you would be holding Ethereum. It's a dead coin anyway. And there is similar price action this year, even with the ETFs coming in for the US dollar price. And let's see if we zoom out. It's not quite as bad, but it's bad. You should have been holding Bitcoin this whole time. And Ethereum people will start realizing this as well. You know, there's some stubborn people that don't want to admit they were wrong, but they will eventually come around and buy Bitcoin at the top. Okay, let's go into some macro stuff. How about gold? Gold is looking like it wants to go a lot higher. And that is, you know, Bitcoin is gold 2.0. It's going up for many of the same reasons, because in a deflationary credit bust, which is what we're going through, a generational one, assets that don't have counterparty risk are like safe havens, right? Because you don't want the value of your assets to rely on a counterparty. And so gold here is not like owning bonds or owning stocks that have a counterparty. This is an actual asset, and it's having a good year. Bitcoin is having a good year, and it does look like this wants to go higher. That is the overall investment thesis here for Bitcoin in a recession. A lot of people don't think Bitcoin can go up in a recession because it's a quote unquote risk asset. But I'm here to tell you, Bitcoin is a risk asset. It acts like a risk asset in some markets, but it also is a safe haven, and it should continue to go higher even in a recession. Okay, so that's gold wanting to go higher. How about the dollar? Dollar is positive on the day, holding this double bear div that we talked about recently at the bottom, kind of above this. I was taking this this spot, tracing it over. We got out of there, back down. I can probably delete that line now because it's not as important. This is the one that we want to break, this daily high close right here. So if we can break that and go higher, the dollar is going to go higher. Now, in the early stages of recession, I mean, leading up to recession, the dollar should strengthen because there's a building dollar shortage in the world. And then at the kind of intense, acute phase of the recession, when we're having market crashes, the dollar should sell off, only to bottom and then go higher again. It will eventually end the recession at a higher level than it came into the recession. And that's just that's due to the dynamics of the monetary system and that the dollars are behind everything. Everybody wants dollars. Everyone wants to borrow dollars. They would much rather borrow dollars than borrow their own currencies. So, especially in acute crises, they would much rather have dollars. So the dollar goes higher throughout the recession and eventually exits that recession much higher. That's what I expect here as well. I continue to expect the dollar to strengthen in stages because nothing ever goes up in a straight line. So if we go out to the monthly chart, people that are familiar with my content, you'll know exactly what I'm talking about here. But let me make this a little bigger. So you can see when QE starts, we're range bound. Then we break out to a new range after QE. COVID, I call this a bottom in my written content that I put out weekly. Called this the bottom for the dollar, and it went up. I was expecting a much higher range, but I did call this top based on the 61.8 Fibonacci. You can see that the 61618 was the top. It actually was 112 and it got up to like 114 or something, but that's a pretty close call for calling the top there on the dollar move. And we're range bound. I said we were going to be range bound. It's a little bit lower range than I expected, but it is still range bound. And the next move is going to be a stair step higher. So there you go. That was the dollar. Let's check out the US 10-year. Go back down to the daily. So this arrow is what I kind of expect to happen. It's getting, yields are going down, prices going up. Yields are going down, price going up. I thought this was going to hold longer as a significant low, but right now we're setting up for a a bull div on the yields, as you can see. So we'll see where this goes. I mean, eventually, when we do get into recession, it's going to dip. But is that now, or do we have, a couple months and then it starts to come back over again? You know what I mean? Right now, it does look like it's slightly oversold. Let's bring that back up. Just touched oversold here on the US 10-year for the yields, overbought on the price. And so I wouldn't be surprised if it did rally here. And again, with a bull div for the yields. So something like this would make a lot of sense. All right. Next asset up. How about oil? Yesterday, I did a episode about peak cheap oil versus peak oil demand and tried to explain why Luke Gromen has been wrong consistently on his oil calls. As we went back and forth on Twitter, actually, so I have an update on that. As we went back and forth a little bit on Twitter, and he did respond. I mean, I think he is a good faith actor. I just think he's wrong. And so I'm pointing it out. It's what people do. And he did interact with not only me, but a lot of different people that commented on the tweet thread. So, that shows some willingness to interact. And I think that is also showing good faith from Luke Gromen. But, he pointed out that as price falls below production price of shale will get crushed. Okay, that's true, but shale can also, that's kind of the opposite of my peak oil demand. As I say, as prices go higher, it destroys demand. There's demand destruction and the price is falling. So you can't really sustain higher prices in oil for the foreseeable future. And we're talking decades. Now, it's kind of the reverse of my position, therefore. And I think it's just kind of restating common knowledge, and it discounts like continuing to get better and better technology. Like we can get 2 or 3 times as much oil out of each well from fracking because of horizontal drilling, because of sleeve technology. And as soon as we start pulling back some regulation that was put on by this current administration, the price, the break-even points for shale, which, is around $50 per barrel, as that will be able to go a lot lower because they will be able to open a lot more leases, drill, open up a lot of pipelines, that type of thing. And the price of oil should fall with the scale. So that is a counter to Luke Groman. Anyway, we can see oil here is positive on the day, about 1.5%, but it just looks really, really weak. Not oversold, just bouncing along this line. I mean, if you see this, okay, oil is not oversold, but it is diving in price. That means it can go a lot lower. It has not hit oversold on a daily. On the weekly, not on the weekly either. It is lower than it has been for over a year. Going back all the way to like September 2022, it was about this low, but the RSI for that time is not significant, or at this time is not oversold. And yeah, so this could go a lot lower. I think this really dictates or demonstrates the lack of demand and how close we are to recession, how much progression we've made towards recession. Just people cannot afford, they're cutting back on everything. There's not as much economic activity, so there are not as many miles being driven. I wonder if people take a look at this and publish like freight miles driven. I don't know if there is a source for that. There are pollution statistics like in China that Steno Research follows, and those are really interesting because, you know, as pollution goes down in China, it's probably because economic activity is going down. And so you can kind of gauge real GDP growth, not the fudged numbers from the CCP, based off of the pollution numbers. But anyway, so that's oil. And finally, the S&P 500, big green day. So initially there was a big reaction down. You can see here at the 8:30 open, fell. It was down almost 1.5% in that first hour and has since reversed very strongly to the upside. So there you go. People weren't expecting this because if the Fed is only going to cut by 25 basis points, that would be less accommodative. That's how they see it. It would be less accommodative for risk assets, which stocks is the premier example of that. So, you know, it hasn't quite worked out. This tells me that we are still in the pre-recession period, but we are getting closer to switching from a pre-recession trade, which is how assets usually behave moving, you know, that last 18 months before recession. So you have about, let's say 6 to 8 years of recovery between these recessions. And then you'll have, you know, a pre-recession period where things are starting to slow down. Numbers are starting to look bad. Things are building on each other, going into recession. That's about, you know, 1 to 2 year period. And then you go into recession. So in this pre-recession period, which I've been talking about for about a year, maybe a little over 18 months, that you should be bullish stocks. You should be less bullish bonds, but still tend towards being bullish bonds, and bullish safe havens like Bitcoin and gold. So all those things have played out. And that's all I have for the macro stuff. Let me go back to the Bitcoin chart and go to the daily, and then I'll take a look at your guys' comments, if there are any. 260 people watching, and there are no comments coming through. Am I going out properly on YouTube? Let me check. Says streaming on Rumble and YouTube. So like, comment, subscribe, guys. If you have anything, put it down in the chat. I'd be happy to answer any of your questions that you have. And let me check here. Spagball says, you just made my workday better with some geek talk. Oh, thanks, man. Glad you're here. All right, well, if there's no comments, what else should we look at? Or should we just call it a day? CK, yo, what's going on, man? What do you think of this CPI today? Came in as forecast, pretty much on the nose. We took a look today at CPI less shelter and how negative that is. Let's go back to that, take a look. So we got this here. You can see CPI less shelter. Really, the last 4 months now have been 0 or lower. and not looking good. That would be, this is the longest string of below zero in this data series. 1, 2, 3. Okay, so this one was kind of equally as long at the end of last year. So that's interesting. But okay, so end of last year, cool down. What if we go into the end of this year and we continue to cool down on this metric? The only thing holding CPI up really over zero is the shelter component, and it will come down. Shelter does not have a mind of its own. It's not like an economy all on its own. It will come down as well. It just takes time for that to happen. And I have seen numbers from rents in different major metropolitan areas, and those rents are coming down as well. But there you go. All right. CK, lows. Did I make a mistake? 50 basis point cut when? I think it's a high probability of happening. If you can see the CME Fed Watch tool here has it at 85% of 25 bips. Citi has come out and said, their analysts over there at Citibank, they say there should be 1.25 percentage point cuts by the end of the year. So 125 basis points. And there's only 3 meetings left. So that means 2 50s and a 25, or 100 and then a 25. I think the odds of a 50 next week are much higher than this 15%. I would put it roughly at 50-50 for this next month. But, are they going to risk it? Are they going to risk having a October surprise in markets and, maybe get some blame about playing politics, trying to do too little and cause a crash that is politically motivated? I don't know. I don't know what they're going to do. I think it's about 50-50. Just by Bitcoin says, yes, sir. Dex Invictus back with us. What's going on, buddy? Let's go back to Telegram and see if there's any more comments here. Let me check outside of the thread, because sometimes people don't put stuff in the thread. Nope. Okay. Well, that's going to do it for me today, guys. I will plan to live stream something short tomorrow. And of course, Friday we'll end out the week with a live stream as well, looking at markets. The major stuff, the major weekly events are over for this week. And we're just waiting for next week with the CME or with the FOMC. But until then, guys, check out my written content at bitcoinandmarkets.com. Sign up there to get free notifications when all of my content comes out. Let me refresh this because I did put out another podcast this morning. Is this the most recent one? Yes, it is, September 11th. So I am putting out these podcast versions of these live streams. You can get my written content like this one, Bitcoin Minute from yesterday, rethinking the Bitcoin and gold debate. We read through that yesterday. You guys can check out yesterday's stream for that. What else? That's going to do it. Thanks for hanging out. Hope you guys have a good evening, and I'll see you on the next one. Bye.